session. No action taken. We don't need to call roll for open session? Great, so we can just start. And we've already approved the committee agenda, right? Is that right? Yes. Item 1? Okay, so we're back on track. So we are, Chris, I think you're back up. We're at item 7.
Wait a minute.
So welcome back.
Nice to have the client advisory in the room. Thank you everybody for coordinating with you. I think that worked out well. Jack enjoyed the technology. He knew what was going on over there, and they're timing it back and forth, so it works out. The same thing I said in closed session, I want to repeat here. Since you like props, I'll waive it. Again, at Tom's request to shorten the agenda, I shortened the CIO report, more graphs and just real direct with less text, so it's shorter. If you like that, I'll assume no response means you like it, but if you want to see something different or more information, let me know. One of the projects, if you remember Adriana Gutierrez, my summer intern, one of the projects I task every summer intern with is to scan the universe, even the Dutch funds and the Canadians, for CIO reports and see if somebody's doing something better and challenge ourselves. I would say that Orange County now has one of the better ones, but it's 35 pages, and I think that would violate what you kind of want. So I'm not going there. But in my report, let's get at the fund size right away, what the gang in the back always likes to jot down. We're at $188 billion as of August 29th, the month end. That is unreconciled. I think it's an interesting teaching moment, especially for everybody in the audience. We're down $1 billion a fiscal year to date. So we ended last year at 189. We're down to 188. But we have a positive return. And some people are, how could that be? We talked about it yesterday afternoon, negative cash flow. So we have paid out almost $1.2 billion in benefit payments over this 2-month period. And yet the portfolio is up once you count that. So always think about the fact that we're swimming in a river where the current's against us. And like this, you know, it looks like we're not even treading water or holding even. We slipped $1 billion, but we're actually up 0.6% on the fiscal year to date. Nothing to write home about. There's a lot of the year ahead of us. And I would say that that's not been uncommon in the summer, is for the summer to start kind of slow. And we'll have to see how things pick up. But I would expect, as we've said many times, it would be very hard to expect this to be another double-digit year. But I admit I said that last year at this time and was dead wrong. So.
Oh, I just didn't want to be known as the person forever in the investment world who said we need no information.
I apologize, Tom. The request from the board was to thin out the board book, be more streamlined and more efficient.
Focus.
1,000 pages is better than 1,500.
Yeah, I'll admit to being the person who said we were sometimes drowned with detail.
I apologize. Here's our asset allocation. Again, as of August 29th, as invested. You can see that, as we've said before, so the graph on the left is the traditional pie chart we put out on the web, but the one on the our right is the ranges. So the red bar is the maximum allocation, the green is the minimum, the blue X is where the target is, and the little dot shows you where we're actual. And so you can see, for the audience's sake, we're within policy in every asset class. You can see that we have very tight ranges, plus or minus 3%. That's much tighter than most of our peers are plus or minus 5%. But we're fairly tightly allocated. The board does discuss the asset allocation at every meeting, and we debate it. Yesterday afternoon, we spent some time talking about our equity, our fixed income allocation, and where should it be, and what is likely to come up. So very robust discussions, and that's the kind of stuff we do in closed session. I'm not going to say any more because Randy Diamond's here in the back of the room for P&I taking notes. Here's the equity market across 2014. There's been a lot of talk about the summer months, but but really a profound market so far this year. It's up about 8% calendar year to date. So when you think about people's 401ks and stuff, it's been a very good year. I think the fourth quarter, we're going to see some more economic growth. Can't say that's going to translate into stocks because it takes a while to show up in earnings per share. And keep in mind, the stock market often is trying to look at the economy 6 to 9 months ahead. So it is trying to anticipate what's going to happen next spring and summer when the Fed starts to tighten. As we've shown the board, generally tightenings aren't bad news. It means the economy is nice and strong, but the market's getting along, and so we wouldn't expect to see it slow. So another stat, Harry Keeley nailed this last night, which was the length of the bull market. So there's a lot of numbers on that page, but basically this is bull markets in the USA in stocks going back to 1932. It shows you the gain, the number of months it existed, and then the gain per month. And what's interesting, in averages can be deceiving. The median is a 60-month period, so bull markets last about 5 years. The current bull market, I think Harry nailed it to the hour, even the day, is 66 months. But what we focus on is bull markets don't die from old age. They die from consumers getting scared or some exogenous event causing companies to pull back and creating a recession. But we know we are fairly long. The other thing that is worth pointing out is this is now the 5th largest or longest and best bull market since the Depression. So it really, we talk a lot about the 1980s and 1990s as being amazing years, but we have really had an amazing rebound off the bottom in the market. And that has what has propelled our returns. I have no doubt that at our offsite and in our future discussions, people are going to say, okay, well, because the last 5 years were so good, the next 5 years can't be as good. And because we look at averages, we say, well, you're right. If the last 5 years has been 20%, the next 5 is going to be below that, the average of 8, and going to be a negative return. The world doesn't work in perfect regimes. It doesn't mean revert, as Steve McCourt said yesterday. It does sometimes, and so that's why we'll pay attention to it. We've been blessed by great returns, and we're counting on those, but we're not counting that it will repeat all the time. This is another chart I wanted to show you visually, which is our valuation indicators. So we send this to you. This is in your quarterly CIO report that goes on the web. It's out there for the public. This is available for the public as well. You would go to the CalSTRS.com page under investments, under quarterly reports. This is one of the first pages in the Chief Investment Officer's report that would show you the valuation. Think of these gas gauges as kind of showing you whether a market, we say rich or cheap. Think about inexpensive or expensive. And so the first is the equity markets, Japan, US, and UK. You can see the US market is right up at that yellow range of being very fairly valued at the high end of the range. Japan and the UK, very low PE ratios right now. A lot of that has to do with the fact that those economies are struggling a bit. The UK is very much impacted by Europe. The bottom one is the corporate bond market. Yields are very tight. Almost, they're in the red zone, and we're aware of it. People are reaching for yield. It has been at that level for a long time, almost 2-3 years. And the reason is because interest rates are so low. So people are willing to take credit risk to get any little bit more of a yield. The other two on the side are the private markets, real estate and private equity. You've said many times that real estate is definitely more than fairly valued. Some markets, I would say Boston, New York, Washington, bits of LA and San Francisco are almost back to 2007 pricing, so they would be down almost close to the red. We're seeing foreign investors, sovereign wealth funds principally, but some of the pension plans buy U.S. assets, real estate assets, at 3 to 4% yields. We don't think that makes sense. They think long-term that's going to be a great play for them, so it's an interesting challenge. And then in the private equity world, the EBITDA multiple is very high. That has a lot to do with the U.S. stock market, and in the amount of capital. So that's why we're a bit cautious on allocating a lot to private equity. People are paying up for companies, and that's usually not. One thing we know is when you pay a high price, the price matters. We always say the sage advice: buy low and sell high. The key is on that purchase price. So here's the list. You always ask me to go up the crow's nest and kind of look out on the horizon. The only negative that's new up there, I moved the taper to the top of the list. The taper ends next month. Some on Wall Street are very worried about that. I think the best illustration I can give you is that Janet Yellen and Ben Bernanke have had their foot on the accelerator all the way to the floor. And for the last year, they've been slowly backing off that accelerator. The car has accelerated, and the car would be the U.S. economy, GDP. It's accelerated, and it's cruising along. Janet's about to take her foot off the gas, but the car's going to keep cruising. She's only going to tap the brake if the car gets going too fast. If it has so much momentum and heads downhill, and in other words, GDP gets up to 4 or high 4%, and she's worried about inflation, then she'll start tapping the brake, and that tapping will be raising interest rates. That's not a bad thing because it means the economy is doing well. She's having to tap it because it's going too fast. So the stock market initially might sell off, but we think long-term it actually will continue to trade up, not 20%, but might trade up. But it will dominate the news. It will dominate the TV networks and the radio networks because they need something to talk about in the meantime. What we're going to focus in on is corporate earnings and what CEOs are saying about their future forecast. A lot of the things on that list are very long-term things and continue to stay there. I'm always amazed at things like volcanoes that we don't think are a problem, and then Iceland has a disruption. If you remember a couple of years ago, they shut off all the European airports. So our world obviously is very dynamic and changing. But on the positive side, we're going to focus in, don't fight the Fed, and the PE ratios are high, but they're not abnormally high. They're not 07 or 09. Or 1999 high, so that we would be very, very worried. So with that, I'm open to any questions.
See any questions from board members? So
Outstanding.
thank you, Chris. Great, thanks. Item 8 is approval of the minutes from July 11th, 2014. I'd entertain a motion to approve.
So moved.
Second.
Great, all those in favor say aye.
Aye.
Opposed? Abstentions? Great, thanks. All right, Alan, PCA, we're going to start a series of semi-annual performance reports, starting with Alan Empkin, PCA. And just an encouragement to our consultants, we like to, ask lots of questions, so keep your comments focused and we'll ask you some questions. So, Alan.
I'll be ultra focused. I'm only going to address 3 pages in the report. With your permission, please go to page INV 27. A couple of observations. First of all, this is for the period ending June of this year. For the 6-month period, the portfolio gained over $8 billion in value, and for the year, over $24 billion in value, and that's net. So that's after the outflow that happens on a monthly basis. On that same page, there are 2 tables. The first table compares your portfolio to the benchmark, and you see that there's a slight negative. That is fully attributable to the benchmark issue on private equity. And that is not a cause for concern, and you're addressing that benchmark issue. That's where that comes from. But I'd just like to point out, if you look at the 5-year number, you compounded at 13.7% a year, which is almost twice what your actual interest rate is. And it's just important to keep in mind that at some point, you'll give some of that back. But if you look at 10 years, you're almost right on the money with your actual interest rate. So in the near term, I think there's probably a good reason to believe you might give some of it back. long-term, you're right where you want to be. Compared to your peers, which is the bottom table, you exceed them over every period. And over the more recent periods greater than a year by plus or minus 1%, which is really a significant outperformance and really puts you well into the top half in the top quartile relative to your peers. So you and your staff deserve great credit.
Alan, can I jump in?
No.
Yes, you can, Chris.
You gotta have a little humor here, you know, and you gotta lighten things up.
I'm going to quote my dad because my 96-year-old dad pointed out this morning, he's that aware of what's going on, that, we're ex-tobacco, we're ex-firearms. While those are fairly small, as we start adding X things, it makes us very different than our peers. So while I love beating my peers and our peers, especially people across the river, and I do my dance, I think you always have to take those with a grain of salt. We have different liabilities, you have a different risk appetite, and so use it as a gauge, but don't make that your sole gauge.
Okay.
And I think I'm going to compound it. Beating our peers with our restrictions and difference in portfolios is very dramatic.
Alan, we don't need it today. I don't know if you know it. Or if you have the information now, it'd be great. If you don't, in the future, it would be fine. The first chart you brought our attention to was relative to the policy benchmark, and you stated that the difference is directly attributed to the benchmark that we've been using in private equity. So we've made that adjustment. It would be interesting to see what the returns, how we would compare to the benchmark had we had a different private equity benchmark, the one that we've adopted. It would be interesting to see what those numbers would look like, if they would be red or in green.
Let me ask my associate if we'll get those for you.
Okay, and then the second question, is it possible to quantify what that outperformance over the 1, 3, 5, and 10-year period would be? If you could quantify that into a dollar amount for a portfolio the size of $190 billion, my assumption is that translates to significant dollar amounts. I mean, it might be helpful to know what the actual outperformance generated in terms of dollars, just as opposed to just the percentages. It might be more powerful to look at that.
That's doable, and we'll have that for you at the next report.
Okay, thank you.
Great.
Thanks, Alan.
Okay. Move to page 29, which is the risk valuations and measures, which we put out on a monthly basis. And I'm just going to ask you to focus on page INV 29. There are two charts, the left-hand column on both charts. So in the top chart, what it says is based upon the measure we use, U.S. equities are very highly valued, which is consistent with Chris's analysis, even though we use a slightly different measure. But a measure, how that is perceived in terms of risk is in the table, in the chart below it, which shows that the Vix Index, which measures the perception of risk in the capital markets, is at an historical low level. So you have extraordinarily high valuations with an extraordinarily low expectation of risk. There's a disconnect. Now, at some point, they go in a similar direction. So one's going to go down, the other one's going to go up. I don't know when that is. I don't think anyone knows when that is. It's just important to recognize that that cannot continue unabated. At some point, you're going to give something back. Okay, the last page I want to bring to your attention is INV 67. And what we do on a regular basis,
I'm sorry, Elena. Yeah.
Before we go on to the next page, the measure of the perception of risk, can you talk a little bit about how that is calculated? Like, what's the analysis that goes into perception?
In the Vix Index, I'm going to ask one of my associates who's the quant to come up here. Either Neil or John, would you come up here to describe Vix? And it is explained in the report in some detail. But it's always nice to have other people who know more than you do.
You're a smart man.
English.
In English, all right.
Yes. For lay
VIX is a measure of implied volatility in the options market, and what that really means is how much people are willing to pay for protection. When VIX is low, people are willing to not willing to pay very much, or people are willing to sell protection very cheaply. And so we say that there is less risk, but what that really means is there's less uncertainty over the short term. So it may not translate exactly to there's less risk in the equity market. It means that there's less uncertainty over the short term. That is, financial players feel like they're willing to insure for the next month, next 2 months.
Well done. I understood that.
Does that help? Good. Thank you, John.
Good.
On page INV 67, what that is, it's what we call an attribution. And so for each asset class, we show the portfolio, its benchmark weight, how much the benchmark weight is different than the policy weight, and then how much difference there is between the return for that asset class versus the return for each benchmark. And then we add all of those up. And if you look at the right-hand chart, you see there's one really big negative number. And that big negative number is selection in private equity. And that's, in our opinion, completely because of benchmark misspecification. So if that was corrected, which you're in the process of doing, that number will end up becoming a positive as opposed to a negative, and you, relative to your benchmark, will show outperformance, at least historically, versus what you have right now. There's one other observation, and that is the biggest difference between you and your peers is many of your peers have more than 50% of their equity assets in non-dollar securities. You have significantly less. Dollar-based securities have dramatically outperformed non-dollar securities in recent periods, and that's been the largest single factor in your outperformance relative to your peers.
Paul, and
Happy to answer your questions.
do you want to?
Thank you. So, Alan, on INV 67, so by asset class, we've got the returns of the portfolio, the returns of what the benchmark was for that asset class. It would be good, I think, for us to also see what our capital market assumptions were for each of these asset classes, because that's how we came to the conclusion of what our asset allocation was.
We're happy to put that in. I just want to, just so people don't get confused, those are very long-term capital
Right.
market assumption, and these are relatively short periods, so there'd be a little bit of a misfit. But as long as we can asterisk that, that's a good addition.
Right, no, I understand that, or maybe something that shows since we adopted our asset allocation, what the return has been, because it may not be that our concern is over the year, but it might be that our concern might be from the time we made those asset allocation decisions and adopted those capital market
We'll
assumptions.
figure a way to put that in the report.
Okay, great, thank you.
Stephen, do you want to provide any comment?
Mostly just amplifying what Alan highlighted in his report. As we've talked about yesterday, and we'll talk more over the next year, the biggest reason that this fund has done better than peers over the last 5 years has been the home bias, the allocation of assets to U.S. equities relative to others. And just to give you sort of a sense of the amount of disparity there's been across global capital markets, on average over the last 5 years, U.S. stocks are up roughly 20% per year. Global equities, international equities, are up about 10% per year, and bonds about 5%. On a 5-year annualized basis, that's about as wide a spread as you'll see across big capital markets. And so to have had a large emphasis on U.S. stocks starting 5 years ago was of huge benefit to this fund. The only slide that I wanted to highlight was INV 65, which again, as we start to think about asset allocation, this slide shows the evolution of asset allocation over the last 5 years, and wanted to highlight that relative to 5 years ago, the fund has a bit more today in the equity market than it had, and a bit less in debt markets. And as we move towards the asset allocation review, my sense is that'll be the most meaningful decision this board has to make, is the amount it has in equities versus bonds, which is the biggest lever in determining the amount of risk and return that you take in your pension fund.
Paul, and then I'll grab you, Alan.
Yeah, a question about that. So we've reduced the amount of fixed income that we have, and that was a decision that we made in the asset allocation process. We're even now below our target in the asset allocation, and my understanding is that we're pretty low in terms of our allocation to fixed income compared to other public pension funds, and just wanted some comment about, has that been a good decision that we've reduced our exposure so much to fixed income in the experience we've had for the last few years, and going forward, what do you think?
Different experiences, so
Yeah,
I'm
yeah,
happy
go
to
ahead.
go first. And almost all of our big public funds have dramatically reduced the fixed income exposure.
Okay.
Somewhere where historically it was 60-40,
Yeah.
it's now 60 plus other, and other is a much broader basket than it was before. One of the big differences is you don't make the huge credit bet that most of the clients make, in that most of the clients' debt portfolios are much more sensitive to the economy than yours is, because yours is really broadly diversified and looks closer to the benchmark, because so much of it is in governments and mortgage-backed, in government-insured mortgage-backed securities. So in fact, you have a much less risky, even though it might be a little bit smaller, it's a less volatile fixed income portfolio, and it's probably a much better hedge than someone who's heavily credit-oriented, particularly with, it could be anything from emerging market debt to high-yield debt to mezzanine and other forms of equity-linked fixed income securities. The one thing to keep in mind when we look at this page, and I'm happy that Stephen brought it to your attention, is that once you deal with public equity, or in your case, global equity and private equity, every other asset class has a lower rate of return. And so the only reason to hold it is to diversify risk. And so that's why it's so important in those other asset classes that they really do that job, and that they're not like what happened in 2008 and 2009 to so many bond managers, is their portfolios had a high correlation to the equity market because they were in high yield and lower quality debt and emerging market debt, which performed more like equities than it did government bonds. And as you look at this issue, it's not just looking at the broad asset class, but it's looking at the characteristics of within the asset class to make sure it accomplishes the objective you would like it to accomplish in the portfolio.
Stephen, did you want to?
100% agree. I mean, what's relevant in terms of risk management for the big risks that you should be concerned with is not the fixed income allocation per se. It's what's truly in conservative fixed income instruments that can be expected to hold their value in in a catastrophic down market.
Thanks. Do you want to chime in, Chris?
Steve, can you describe your client's experience? So our target is 17% in fixed income. Where does that stand relative to your other clients?
Our experience sounds like it's quite similar to PCA's. Client allocations to fixed income have really been a function of new fixed income asset classes that have been introduced to pension funds, all of which to one degree or another involve some degree of credit risk. So funds that have moved money into more money into high yield bonds, into emerging market debt, into higher yielding bonds may have a higher allocation than you have to fixed income. But when you separate those out into the risk factors that they truly represent, the allocation to truly conservative investment grade bonds is pretty consistent with what we see here at CalSTRS. That's not to say that you and the market are right or wrong. That's a value judgment on the amount of risk you want to take. But I think relative to peers, it's pretty consistent.
Thanks. Thanks, you guys. Thanks, Alan, Stephen.
Great, thank
Anything
you.
else? Okay, thanks. All right, we'll move on to Michaelin.
Good morning. Mike Lynn McGee with the Townsend Group. I am presenting the first quarter's performance measurement report. I'll remind you that we lag a quarter in the real estate, and actually feels a little bit like 2 quarters when you're presenting it in September. But so these are your numbers as of March. And I'll make some comments also about the in the interim since the March period ending. Clicker.
Here, sorry.
Or is this your own?
This is the same thing that you have in your
Okay.
books.
So you're just going to highlight a
Yeah,
few
and I'm going to
few
work
things?
with, I seem to be misnaming out, just so you can rest assured, we're not going through anything that's in the closed session section. They printed the entire report with all of the addendums, and that's in your closed, that's not what I'm going through in closed session, so you don't need to worry about it. We're going to start on INV 132. And this chart shows your performance as of March 31st. I want to highlight first the 1-year number. Obviously, loving the dark blue bar. We're beginning to outperform the benchmark on a 1-year number. We're doing so on as of the first quarter, and also as of the 3-year. Oops, that's the wrong. Okay, I'm sorry. Something's weird, but I'll go through this to make sure we're on the right page. Okay, so this INV 132 should be your funding page. That makes sense. And here, just highlighting that the percentage of the CalSTRS portfolio for real estate as of March was 12.2. You'll remember when staff was in front of you at the last meeting and talking about real estate, we talked about the fact that in liquidations, as well as with slower investment pace, we are projecting that the portfolio will decrease its relative allocation. We'll continue to look for opportunities, but we do expect that we'll stay well within that range, the tolerance range, and probably under the new established 13% target, unless the market starts to open up some additional opportunities for investment. This page shows the period ending March 31st for the total portfolio. Not as great as the one we're going to talk about next, but you'll see that for the 1 quarter, you're outperforming both the NFI Odyssey, which is your benchmark, as well as your real estate benchmark, which would be the blended portfolio, kind of the risk-adjusted, given how much you have in core and how much you have in non-core, what your return target should be. Similar performance in the 1 year with respect to your blended portfolio, but underperforming the NFI Odyssey. And then as we move further out, we're still seeing the impact of the legacy assets in your portfolio, but very happy with what we're trending with respect to go-forward performance and newer investments as they start to outweigh the historical investments and underperformance that those investment portfolios are still contributing. I'm going to go back to that other page. I'm not sure how it got out of order, but that's the page. The next page is this slide that you see in front of you. This is every investment you have made since the market correction. And I highlight this page because it's important to see that the new investments that you're making are doing exactly what we need them to do. They have yet to reach a level where they can compensate for the existing legacy investment portfolio that was in place and primarily invested towards the peak of the market. But they are outperforming all of the indices as well as your benchmarks, and they're doing so on a lower risk profile than what you were doing previously. All right. This chart is generated by your staff, again, just showing you graphically the projected allocation for real estate relative to the targets, and showing you, again, that all of your risk categories, core, value add, and opportunistic, are expected to be within their ranges by the end of the first quarter of 2015. And I think I've pointed out to you a number of times that it's at least 2 years, if not more, quicker than we expected that to occur for you, given the opportunity to invest in the activities of your staff. With respect to staff activity, I'm going to first step back and talk a little bit about where we see the markets, and primarily talk to you about the core U.S. market because it is driving your portfolio as well as the real estate markets in general. The fundamentals of core real estate appear to be stronger than we had anticipated and predicted. And what we mean when we say that is that as we look at the open-ended funds that make the composite your portfolio is benchmarked against, we see that all of those managers are, most of the managers, I should say, are exceeding projections they had for growth of their net operating income. So same store, looking at their assets they held last year and the assets that they hold this year, they predicted about an NOI growth somewhere between 3%, and it's been around 5% is what we're on track for the year. So we're exceeding expectations. That's directly about income. Chris mentioned in his report the indicators for real estate and the cap rates being highly priced and looking at 3% and 4% cap rates, averaging somewhere around 5%. What that tells us is that we may be fully priced, but when we look then at the income, we have a cushion because the income's continuing to grow and leasing continues to be in high demand. And this is across all markets, generally speaking. Clearly, it's more heated in areas like San Francisco where we personally will be looking for new space. We'll be leaving a rental space that we did 5 years ago for $24, and market rents are $80. So we're not happy about that, but we need more space. But you can see that kind of a growth pattern, especially in some of the key markets, is continuing to allow core real estate to appreciate and have a considerable amount of its return generated through market value improvements. For the full year, as of the second quarter of 2014, the Odyssey achieved a 12.16% return. The 40-year average for Odyssey is 7.16. So we are 500 basis points above the long-term average for the index. As they've said in the other asset classes, this can't continue to go on. We do expect it to moderate, but we keep saying it's going to moderate, and it hasn't. With that picture in mind, I want to walk you through what your staff has done with respect to core. They have been, as we indicated earlier, continuing to move towards those target ranges and get in compliance with the strategic plan that was adopted in 2010. They expected, again, it'll be done by mid-2015 at the latest. What they've done is they have invested in large, diversified, open-ended commingled funds. Those are a big portion. That is the index you're tracked to, and it's becoming a larger portion of your core portfolio. But you continue also to have outperformance in your separate accounts, your separately managed accounts where you have more control and can really control the spigot of putting money in and taking money out with liquidity. Importantly for us, they continue to invest in open-ended funds that Townsend holds in what we call our model portfolio. So to your discussion earlier about managers that we like or don't like, what we would say is that your staff has been extremely consistent in picking what we consider to be the best performers and the most likely to outperform the index on a go-forward basis. So we think their selection process has been very successful. They have taken part in some of the unique new core open-ended funds that have some level of either retained earnings, a retained valuation that the manager is giving to the new investors or founding investors. There's also been a number of significant fee benefits that your staff has negotiated by virtue of your investment size that all lend themselves to achieving net of fee returns that outperform the index. They did make their first entrance into an international core fund. That's the Asia Core Fund, and we'll begin to see that get invested over the years. That's to allow for diversification. Well, we would call that a toe in the water. We expect to do more, but we want to see how that goes. They continue to make additional allocations to apartment managers, something we would have been a little bit leery about, but quite candidly, they were right. The market for apartments has continued to be sustained. There's still an undersupply in most markets. And both the value to core, where they're building or rehabbing apartments and putting them into the core portfolio, as well as core positions in multifamily, have been very accretive to the portfolio. There has been limited opportunistic activity. That's consistent with the rebalancing efforts that are required, but we do need to continue to invest in non-core in order for you to reasonably achieve your return expectations going forward. And they've made remarkable progress in reducing your leverage. It's down to 42.5% from the peak of 60% that we started with. With respect to initiatives that the staff has undertaken, and we will get back to you and talk about in detail in closed session in future meetings as they move forward, we are taking a look at what we look at as those legacy investments, the ones that on a go-forward basis will not hit the non-core return objectives simply because of when the assets were purchased and the type of holdings, and what we can do to ameliorate the impact of those, as well as to change even the holdings, maybe looking at secondary markets, looking at different opportunities to exit, buying out other investors and controlling funds, looking at a myriad of strategies that they can actively take a part in right now and have that part of the portfolio not be such a weight on the overall performance. And that will be limited. I'll be candid with you on staffing resources. It's one of the reasons it's just now being really seriously looked into, because there's been a lot of remodeling, rebalancing the portfolio and activity going on, and we have limited resources within the real estate group to manage all of the investments and all of the initiatives that need to take place. But it's a good time to be doing this, and I think it will be accretive to the portfolio as they move forward. I'm not going to go through the market overview because I really wanted to just focus on the core market here, but what you'll see is just really and this is our second quarter or our first quarter market overview. We are in the process of updating that now. These are just the major areas and what we see in the markets, and each of the pages gives an overview on where we see opportunities. This is Townsend's perspective solely. And where you see overweight or neutral, we're talking about, in the global perspective, we're talking about that relative to just those particular markets. So we would say office, we're neutral to office in the United States, so we wouldn't be doing a whole lot of investment opportunity in office, but we might touch on it given a great opportunity. But when you look at just the core market, I'm not sure what we got here, but we won't do it. We also have a page in the printed materials that gives each of the different countries in more detail, particularly the United States, and that's relative to the Odyssey benchmark. So that's where we would be looking for your portfolio to be under or overweighted. And I can answer any questions.
Any questions from board members?
I apologize for the slide mix-up.
No, it happens. It happens. No worries. I don't see any questions, so thank you, Michael. I appreciate it. Thank you. All right. Mike Moy. Hello there.
Mike Moy from PCA. You've heard a lot about the change in the benchmark for private equity, so I will not say anything about that. We'll come back with that information that Harry wanted, because I think that will be enlightening and eye-opening. If you look at page 221, we've kind of changed the way the report was done this time, trying to make it a much more concise report so that the number of pages would move more towards your desire to have less pages. I think we probably still have a lot of room to go in terms of what we could leave out, but that's really going to be driven by feedback from you all. The basic, if you look at the table on page INV 223. The private equity program has had, on an absolute basis, outstanding performance. It's been one of the better, if not the best, performing asset class that you've been in, and the expectation is that that can continue. I can't tell you the duration of the continuation, but it certainly has been something that, the managers are working at it, let's put it that way, and staff is working very hard at getting the right managers. Your program has been cash flow positive, as you can see on page INV 225, since 2011. The distributions that have been coming in have been superb compared to the capital calls. How long that can continue is also unknown. I'm guessing that it's heading in the other direction as we go forward. The level of distributions that you've been getting versus the capital calls that have been coming from managers is presenting an issue from an allocation perspective, because the total portfolio, total fund is growing, but the assets of private equity potentially have been shrinking, so the allocations have been coming down, and that's generated a need for, continuing to make commitments in the marketplace. And staff has been doing a good job of that. As you can see on the bottom of page 221, in the last 6 months ended March 31, they've made 14 new commitments, aggregating at $1.5 billion. I guess I will turn it over to you and say, do you have any questions on the rest of the material? Because it's self-explanatory, I guess is the way I'd put it.
Mike, could you look at INV 244? So can you explain this table to me? I'm not sure I really understand that there's a box at the bottom that says if STRS had invested in each of the two options shown, I'm not sure what those two options are. Instead of investing in private equity, his portfolio would have had a value of, et cetera. So is this saying that our actual return was 11.73, but looking over on the left, but that there was an option that we could have pursued that would have produced 17.21%?
To be quite honest with you, Paul, this is a chart that was developed when you had a different benchmark for the private equity program, and it was used as a way of attempting to explain the performance of that benchmark. And technically, we should have pulled it out from the report because it's no longer really applicable. Because you were using, you were recognizing or accounting for the J curve by a treasury bills proxy, and you haven't been using, the J curve has been dissipated because of the new benchmark that was being used and then the new one that you're going to. So this table really does not have any significance.
Okay. So we won't see it in the future?
That's right.
Okay, thank you.
And Paul, if I can jump in, to partially answer your question, you asked was there something we could have invested in that would have earned a higher, that rate of return? The answer is no, because that's the public U.S. stock market plus 300 basis points. And there wasn't anything offering an extra 3% over the market. If we had earned the market in this 3-year period, yes, we know that if we'd invested in the Russell 3000, we would have earned more than private equity for that discrete 3-year period.
Thank you.
Tom?
Never mind, I'll save it for the.
Okay. Great. I don't see any other questions, Mike, so thank you.
Thank you.